Let's hit Apple now because it is the stock story of the day and what's pressuring the NASDAQ. Reports China's banning the use of iPhones by government officials, a ban that some warn could grow beyond government officials.
The latest is that these restrictions could apply to local governments. The Nikkei has reporting that. In addition to that, they said that some of their sources at state firms have said that the restricted list also includes AirPods as well as Apple Watches.
What's going on with China, iPhone ban, and Alibaba? How Apple stock is affecting Baba stock. Apple down 3.6% yesterday. Another 3% today. Why? China's banning iPhones for government officials while they're at work? Bad news is China's 19% of Apple's revenue. Good news is iPhone 15 unveiled next week. Let's pray that they drop more than a $20 microcloth. Apple is going to bring down the NASDAQ if this continues because China seeks to broaden the iPhone ban to state firms and agencies. You people do realize that there's a boatload of Chinese government employees, like 60 million of them. That's more than the population of Canada. Apple just lost a market the size of UK so far. Why is China banning Apple is hurting Alibaba stock? I will explain it all right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Welcome back to the Audacious Money Witch channel where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because you're already a success. It is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? Apple is expected to introduce the iPhone 15 on September 12th to the world. China is Apple's second biggest market by sales outside of the US. It accounted for $74 billion of Apple's revenue, another important metric. China grew faster by revenue than Europe, implying continued prospects for growth for Apple beyond saturated Western markets. Unfortunately, China is now ordering government officials not to use iPhones for work, amid a Washington and Beijing tech war. For clarity, it is not a ban solely on iPhone, but foreign phones, and it is not a ban from buying them or using them. The ban is not allowing bringing them inside the government office. The government staff were given these instructions by their superiors in recent weeks, according to the Wall Street Journal. China is also striving for self-sufficiency in the tech sector. It could have a significant impact on Apple. China's ban on foreign phones, brands, and government agencies mirrors similar restrictions in the US, such as a New York City ban on TikTok on government-owned devices. The Chinese yuan dropped to a 16-year low against the dollar as pessimism grew toward China's economy and financial markets. Its property market is a huge heap of failure, spreading trouble to the country's lenders and heavily indebted local governments. Chinese consumers, who were expected to lift global demand, are downbeat. The sharp rise in youth unemployment isn't helping. Chinese imports have tumbled, while exports, once a robust engine of growth, are in decline. The country is registering a drop in prices, adding to signs of a significant economic slowdown. Alibaba stock have fallen to a fraction of their value 3 years ago, spurring some investors to search for value. But will Alibaba stock rebound and reward their investors? Right now, foreign investors continue to dump Chinese shares, with outflows accelerating in August to a record $12.5 billion. Growing tensions between the US and China over trade and technology, as well as the concerns about worsening of the Chinese economic situation, are diminishing investors' appetite for the China's stock sector. The central government announced some measures to boost the economy, but in truth, they can't do much because the country is too indebted on all levels. Total government, corporate, and household debt standards at around 280% of GDP. And that's only the debts that are on the books. Adding government stimulus could jolt economic growth for a short while, but seriously exacerbate debt risks in the longer run. So Beijing has lately been signaling to the Chinese technology sector, and particularly to the owners and managers of leading tech companies like Tencent and Alibaba, that they aren't enemies of the state anymore, but heroes on a mission to save the economy. Government officials promised policy support and loosened restrictions on the blossoming generative artificial intelligence industry to allow competition with the US tech firms. Meanwhile, once burned, investors in Chinese firms will not easily forget the government's earlier heavy-handed approach towards private enterprises. These included eliminating the whole online education industry, forcing Ant Group's IPO suspension, slapping heavy fines on Alibaba for different violations, and many more actions that caused Western investors to reassess their sentiment towards Chinese stocks, including this recent iPhone ban. It just creates a dark clouds above Alibaba stock. The economic picture is the easier one to decipher. China's momentum seems to be waning. It now faces multiple challenges, preventing it from returning to the past decade's double-digit growth. However, the giant is weakened, not fallen. The country is still expected to grow at an average annual rate of 5% in the next years, a clip that would exhilarate any developed economy. Its population of 1.4 billion, of which about 400 million belong to the high consumption middle income group, isn't easy to ignore. Even in a slowing economy, the vast consumer base, known for its wide technological adoption, still presents an enormous feeding ground for Chinese companies like Alibaba. They may not continue growing their earnings as fast as they did before the lockdown, but they will still be able to grow and prosper if the CCP allows. The main risk to the Baba stock is political. Yes, however, Baba stock is likely to see market sentiment on its stock reverse from here, which can be attributed to the company's persistent growth. When we look beyond the intricacies of politics and drama, Alibaba's actual financial results have been quite remarkable. The stock may still be trading at the same levels it did back in 2014, but its revenues have grown massively since then, particularly in fiscal 2014. Alibaba reported revenues of $8.45 billion. In the last 12 months, revenues amounted to $123.7 billion. That's roughly 14.6x growth in less than a decade. Such a prolonged revenue growth record might imply that the company must have entered a maturity phase. Yet, the pace of Alibaba's growth remains at satisfactory levels. In its most recent Q1 2024 results, the company achieved revenue growth of 14% to $32.3 billion, kicking off fiscal 2024 on a high note. Alibaba's core businesses also posted exceptional results, with its international digital commerce group seeing its retail businesses achieving order growth of 25%. AliExpress posted robust order growth, driven by an increase in the number of transacting users and enhanced consumer experience. Most investors are familiar with Alibaba's core platforms like AliExpress, but few seem to be aware of the company's local services group and Tainio Smart logistics network divisions. Following stronger user growth, revenue in the segment grew by 35%. Finally, Alibaba's Cloud Intelligence Group, one of its flagship businesses, demonstrated consistent growth, highlighting the increasing demand for cloud services. Despite China's economic slowdown, the division achieved a respectable 4% revenue growth rate in a cost-conscious environment. This resilience suggests the potential for a robust rebound once the economy recovers. Alibaba's leadership is aware of the significant undervaluation at which Alibaba stock is currently trading. Consequently, they have taken decisive action to counter it by aggressively executing their share repurchase program. For context, during fiscal 2023, Alibaba repurchased a record $10.9 billion worth of stock, around $1.2 billion more than in fiscal 2022. Share repurchases are likely to be substantial this year as well, since the company bought back $3.1 billion worth of stock in Q1 alone. Alibaba has already reduced its share count by 6% over the past 2 years, with the pace accelerating. Overall, Alibaba's enduring growth story continues to contrast with its stagnated share price. Its solid revenue growth and profitability, coupled with a discounted valuation, form a compelling case for investors. I will keep holding my shares in Alibaba and remain bullish on the company's outlook. You are such a good boy for watching my video right till the end. Bye.